Hello guys, welcome back to the channel. In today's video, I come at you straight off the driving range for another update on my Hargreaves Lansdown Stocks and Shares ISA portfolio. So for those of you that are new to the channel or haven't seen this sort of series before, I basically talk you through my £10,000 Stocks and Shares ISA portfolio on Hargreaves Lansdown. I've recently been able to add some funds to it for the first time in a few months, so you'll see that update on the spreadsheet and in the charts. But yeah, it's a pretty simple concept. I'm sure you've seen it elsewhere on YouTube, and let's go into it. But of course, as always, before I move on, I just need to make the disclaimer that this video is not financial advice. This video is for education and entertainment purposes only. So with that said, we'll come on to the Excel dashboard before later moving on to the TrustNet charting software, where we can break down the portfolio fund by fund. So here we are on the Excel dashboard, and we're going to start at the bottom because the most exciting thing to happen in this series since March has been the addition of £900 of funds. Now you can see that I'm somewhat predicting the future here because I haven't actually been paid yet. I'm going to get paid on Monday, which is in 2 days' time. But I expect to be putting £900. Well, I know I'll be putting £900 in on Monday. There could be more in a few weeks' time, depending on how the month goes. But it's the first time I've been able to add to this portfolio since March due to my car costing me £1,000, buying a new phone and a laptop to help with this series, going on a couple of holidays to Rome and Wales, which were fun and definitely worth it. But yeah, all that's meant that I haven't been able to put any money into this portfolio. And that is going to change this month, which is good. And you can see where that's going to go up here. So let's again talk through the portfolio, remind everyone of what's in there, and then talk about the buys and the reason behind those buys. The portfolio itself, we've got two sort of main components to it. We've got the defensive steady eddy type funds. It's all made up of mutual funds. There's no ETFs, no investment trusts, no specific stocks just yet. These are just mutual funds actively managed by rather well-paid portfolio managers in either New York or London. And yeah, that's how I've chosen to... Actually, that's not true. I've got the Health and Pharma, which is passive. But anyway, the point of the portfolio is there's a defensive component and a more aggressive component. In the defensive side, we've got Polar Capital Global Insurance, which is supposed to be sort of uncorrelated to the business cycle because it's insurance. Think about car insurance and the concept behind that. We've got UK, which is a defensive market in Fidelity Special Situations, and then we've got Health and Pharma, which is supposed to be, again, that steady eddy, uncorrelated to the business cycle because people are getting ill anyway, people are aging in the West and all that sort of stuff. And you can see that through the sort of market turmoil we've had, that's broadly worked, not quite on the Health and Pharma side. So we've got the best performing funds so far being Polar Capital, the UK fund, and BlackRock. But anyway, Health and Pharma is supposed to be part of that defensive component. And then in the aggressive component, we've got US small caps actively managed. We've got a tech fund, again, actively managed. And then we've got BlackRock Global Equity Unconstrained, which is a global equity fund that's pretty much BlackRock's best ideas from one of their star hedge fund managers, which you can find elsewhere on my channel. So where we are today is the market's rallied pretty significantly from the tariff fears early in April. And I think that leaves markets in somewhat of a precarious position. So I'm putting money into the defensive component in Polar Capital Global Insurance and the Health and Pharma. The reason for the 600-300 split is I'm far more confident in insurance over the next sort of 2, 3, 4 years. And then Health and Pharma, Trump has specifically said he's going to go after that. Now, in terms of he's going to try and get pharma prices down and therefore hurt the profits of pharma companies. I think Trump is quite evidently losing ground. His approval ratings are falling through the floor. He's having arguments with Elon Musk over Twitter and being named as one of Epstein Island visitors. I'm not sure if you guys have seen that. I'm sure you will have done if you spend any time on Twitter or anything like that. But anyway, Health and Pharma is a bit precarious, but it's down quite significantly. And I like to try and buy low, sell high. Hopefully this is a bit of buying low and maybe selling high in the future. Coming down then, you can see that we're still down on the portfolio since I invested. When we come onto the charts, I'll remind everyone of the timing of this series and how poorly timed the start of it really was. But we've had a nice little uptick or we will have a nice uptick once I put the money in from my paycheck in a couple of days. So yeah, we can say, as you can see, it's still down. We were down almost £2,000 at one point with, again, those tariff fears. The more aggressive parts of the portfolio in BlackRock, Columbia Threadneedle and Henderson were down significantly, as were the others, to be fair, but them more so than the rest. And then as a UK investor, you might know that the US dollar has been down quite significantly over the last, well, since the start of the year really, but definitely over the last month or so. So, well, 2 months really. So it's hurt returns, where in the last couple of years it's helped returns. That's just a part of investing internationally and what Trump has basically done to the US dollar and trust in the US. So that's the portfolio snapshot. We'll go on to TrustNet now and have a look at some charts that really help break that down and show you and help you see exactly what I'm seeing. So here we are on TrustNet, and I'm going to start off with a chart that makes me look not too clever, but it helps provide context as to where the markets have been. So I started this portfolio series here in February, and what you can see on the chart here is my portfolio and the IA global sector, which is global. Any fund that's global equities goes into this sector, and what you can see is I've underperformed it, which again isn't great, but given the small cap exposure, I'm taking picks here. I'm actively selecting what areas I think are going to outperform. Over the short term, clearly that's been wrong, I guess you could say, but I'm confident that over the longer term, you will see my portfolio outperform the global sector, given the themes and the areas that I've allocated to. But the purpose of this chart is to show you that, again, I started the portfolio series up here. We had an instantly huge crash. We've had a pretty decent rebound. And I think with the instability that's out there at the moment, yes, we should have had that sell-off. We should have had a little bounce back, but I think the bounce back has been a bit extended and it's got me a little bit on edge. So that's the context. The next chart I wanted to show you guys was a chart that has the two funds I just recently added to, or will be adding to, and then the IA global sector. In the orange, we've got Polar Capital Global Insurance over the last 10 years. You can see it's just absolutely smashed it. And that's in an environment with basically zero interest rates, which is a headwind, or at least not a tailwind for this sector. We've now got interest rates at, call it 5%. Massive tailwind. If you watch my other video on insurance, you'll understand why that is. But it's also very steady. Like, yes, it crashed in COVID, but apart from that, very little drawdowns. I love that fund. That's why it's the biggest holding. Second thing, let's zoom in actually. Let's take Polar Capital Global Insurance off. We've got the IA Global Sector and the Health and Pharma Index. Now you can see that for the most part, they track each other quite closely. You've got that general beta exposure, general market beta that drives everything really. But more notably, I think, you can see that the volatility in the healthcare sector is quite a bit lower. Drawdown in COVID, lower. This sharper rally up was more muted in the healthcare sector, but we ended up at the same point because of that lower drawdown. Then we had 2022, where there was a big sell-off, especially in the large cap names, particularly in tech. And again, you had healthcare, the black line, sort of steaming through and really not seeing much of that drawdown. Again, on the recovery, it was less sharp, but typically the performance profile means that you end up in the same place, but with less drawdown and then less subsequent upside. So it's quite decent performance for less volatility. The interesting thing now, you can see there, the recent divergence in the lines, it's the most severe in the last 10 years. Excuse me. And again, a lot of that will be to do with the Trump rhetoric. I think United Healthcare missed an earnings report, missed their earnings expectations in the last couple of months, which has got quite a sizable weighting in this fund. It's been smashed, but that sort of divergence, that gap between the global sector and the healthcare sector, looks to be the largest it's been in the last 10 years. If you have a June 2015 starting point. So again, it's that idea of trying to buy low, sell high. In this instance, I'm trying to buy low. Healthcare has got a long runway for growth. I think we all know that populations are not the healthiest at the moment. They are also aging, especially in the West, where the money is and where these health and pharma companies generate a lot of their revenue from. And then you've also got the simple fact that a lot of these companies have politicians in their back pocket, and therefore can take advantage of that really. Final chart then is each of the funds in the portfolio over the last 6 months. There's quite a lot of interesting stories on here. If I do each one, it could take a little while, but let's just see how we go. Let's try and rattle through them. First, you've got Fidelity Special Situations, which is the UK fund. Smashed it. The UK market's been in favour. Firstly, as the US has looked relatively less attractive. You've seen UK get some flows. Secondly, it was attractive anyway, not just on a relative basis, but on an absolute basis. And thirdly, you didn't have the US dollar headwind as a UK investor. Again, any international holdings, US-based holdings that a UK investor would have been hit by the US dollar weakening over the last 6 months or so, down about 10%. So even if you had a flat S&P 500, a UK investor would see negative 10% on their holdings because of the US dollar falling. Second story, Polar Capital Global Insurance. I think the insane thing there is you can see when Trump tariffs hit in early April, the fund barely flinched, barely went down. It's US dollar denominated and it still barely went down, which is just absolutely boom. E is quite an interesting one. Again, there was a lot of euphoria around US smaller companies when Trump came into power, and very quickly from January, his pro-economic rhetoric changed, or at least the market's interpretation of his rhetoric changed, from being very pro-business, pro-growth, all that sort of stuff, to being quite the opposite. And so not only have the share prices fallen, but again, you've got that USD story. That fund will be 100% US assets, and therefore been hit twice as hard. F's the health and pharma. We've already covered that off. It's fallen quite a lot. It's barely even participated in the recovery since bottom of April. It's actually gone lower than its April low. So that looks like a buying opportunity to me, not financial advice. Tech and BlackRock are both highly geared to economic growth sentiment, if you like. So you can see they're quite highly correlated there. There is a lot of tech in the BlackRock fund. In fairness, I think I know their largest holding is Microsoft. And again, you've got that USD story. So you've got tech selling off, economic growth as a factor selling off, US dollar selling off, and then you've had that rebound. I think if you were looking at the USD in USD terms, then they'd pretty much be back at their highs from before. I know that the S&P is only down sort of 2.5–3% from these all-time highs. But again, the UK investor sees it as worse than it is. And that's it. I've just realised I've covered them all off. There's none that I've missed out, so that's good. That's that. Very quick run through. I think I've touched on quite a lot of stuff there, but hopefully you found this video helpful. Hopefully you found it useful. If you did, please leave a like and share it with literally everyone you know, because I want more views and more subscribers, so thank you very much. And yeah, subscribe if you're new, and I'll see you in the next video.